Want to know the secret to maximizing your investment returns? It all comes down to a simple choice: active or passive funds. But how do you decide which is right for you? Stick around, and let's break it down in a way that's easy to understand. Imagine you're at a buffet. You have two choices: a chef who's preparing custom dishes just for you, active funds, or a well-stocked table where everything is neatly organized and ready to serve, passive funds. Both have their merits, but which one fits your financial appetite? Let's dive into active funds first. Think of them as a roller coaster: exciting, thrilling, and with the potential for big highs. Active fund managers are like skilled ride operators, constantly making adjustments to navigate the twists and turns of the market. They research, analyze, and select stocks they believe will outperform the market. This can lead to substantial gains, but it also comes with risks. If they make a mistake, your ride could go downhill fast. Now, let's look at passive funds. Picture them as a smooth sailboat, gliding along steady waters. Passive funds, like index funds and ETFs, aim to mirror a specific market index. Think S&P 500. They don't try to beat the market. They simply aim to be a part of it. Because they require less management, these funds usually have lower fees, which can significantly impact your returns over time. But why does it matter? Here's where it gets interesting. Research shows that over the long term, many actively managed funds fail to outperform their passive counterparts. In fact, a study by S&P Dow Jones found that over 80% of active managers underperformed their benchmark over a 15-year period. So, if you're in it for the long haul, passive might just be your best bet. Now, let's talk about risk tolerance and time horizon, two crucial factors in your decision. If you're someone who can stomach the ups and downs of the market, and you're investing for a longer period, active funds might be appealing. They can capitalize on short-term market movements and potentially provide higher returns. But if you're more risk-averse or saving for something like retirement, a passive approach might give you the peace of mind you need, with a steady and reliable growth trajectory. Here's a relatable example. Imagine two friends, Sarah and Tom. Sarah invests in an active fund, excited by the potential for high returns. Meanwhile, Tom opts for a passive fund, trusting in the market's overall growth. Fast forward 10 years, and while Sarah experienced exhilarating highs and painful lows, Tom's steady growth allowed him to sleep well at night. Both may have done well, but their experiences and stress levels were worlds apart. Now let's touch on fees. Active funds often come with higher expense ratios because of the research and management involved. These fees can eat into your returns. On the flip side, passive funds generally have much lower fees, which means more of your money stays invested and working for you. So, what's the takeaway? If you're seeking potentially higher returns and can tolerate some risk, you might lean towards active funds. But if you prefer a simpler, cost-effective strategy that often yields solid returns over time, passive funds are likely the way to go. Before you make a decision, consider your financial goals, risk tolerance, and investment timeline. The right choice for you may not be the same as for someone else. As we wrap up, I want to hear from you. Are you team active or team passive? Drop a comment below and share your thoughts. And don't forget to join us next time when we explore a hidden gem in the investment world, an asset class that could transform your portfolio. You won't want to miss it.